Good morning, welcome to the Fit to Flourish podcast. Let's talk wellness, finance, and growth.
What's up, guys? It's Mr. Fit to Flourish. Today I wanted to talk about 5+ chart patterns that you should know as a beginner to make big gains when trading. We talked about a couple patterns yesterday, so that was our part 1. This is going to be part 2 of a pretty good series of patterns to recognize when trading. So you don't need to know ICT, SMC, 1, 2, 3 patterns or concepts. You just need to know what the chart looks like when it's about to do something. Okay, that's what I like to call it. What does the chart look like when things are about to happen? Man, let's take a look at it. So in order to understand this, the first thing that you're going to have to understand is candlesticks. So we talked about candlesticks. A lot of people don't know candlesticks. So Japanese candlesticks, green bars mean we're going up. You start at the bottom of this rectangle, and at the end of that time period, that time session, so 5-minute time frame, 10-minute time frame, an hour time frame daily, at the end of that time frame, we end here. So during that time period, we went as low as this low and as high as this high. And for a red candle, that means we start up here at the top part and we end at this low part of this middle rectangle. The middle rectangle is called a body, and the skinny parts, these tails, are called wicks. Okay, that's what you need to know first and foremost. So, and then we need to understand trends. So what is an uptrend? An uptrend is when we're getting higher highs, higher lows, and from left to right, the chart is going up. Downtrend is bearish. So lower highs, lower lows from left to right, the chart is showing that price is going down. The candlesticks are going down. All right. Trend versus non-trend bars. So this is a concept where trend bars are big bars that contribute to the direction of a trend. Non-trend bars are those small bars or dojis that do not contribute to the direction of a trend. What does that look like? Look at this. This is a downtrend, right? Because from left to right, we're going down. Big red bars show that that they're pushing price down. And then when we get to these small little bars, non-trend bars, price just goes sideways. And then from left to right, we're going up. You'll see big trend bars causing price to move up. And then these little tiny bars where price just goes sideways, that's non-trend bars. And then in another video, we'll talk about auction market theory and how price moves and why it moves. So we'll talk about the 4 phases of a market cycle: accumulation, markup, distribution, and markdown. Talk about that later. And we talked about setups in a couple other videos, but these chart patterns allow you to have setups. So let's talk about some of those concepts and what these patterns look like. So one pattern to recognize is dissipating buying pressure. This concept is basically showing you, like, when you're in an uptrend, you see the prices moving up and moving up and moving up, and you're like, dang, when should I get out the trade? Or dang, when should I get into a short? Well, look for signs of dissipating buying pressure. What does that mean? That means that the pressure to buy, like all that buying, is going away. It's dissipating. How do we know? How do we know that's happening? Well, we get long topside wicks. At the top of an uptrend, we get these long topside wicks, and that basically shows you that sellers are stepping in and pushing price down. What else do we get? In an uptrend, we start to get decreasing bar size. And then we also get that topside wick. So decreasing bar size like this shows you that there's less and less buying. Look at that big green bar, and then pretty big green bar, but it's smaller. And then still pretty decent sized green bar, but it's smaller. And then we get a non-trend bar up here. Non-trend bar. All right, and then bottom side wicks. So long bottom side wicks shows that buyers are stepping in. So it's known as dissipating selling pressure. So selling pressure is going away here. When we get at the bottom of a downtrend like this, we get a long bottom side wick. And this is called a spinning top doji or a hammer doji. I like to call it a slingshot doji. So those concepts are really, really important. And then we need to understand on the chart, this pattern right here of really just a bar with no tails. So big bars with no tails are a sign of strength. So that shows you that at the end of the session, the end of the trading session, people were still buying the price up, and they were buying it up so much that it closed at the highest point on this bull bar. Ooh, here we're getting into the pretty serious chart patterns here. A cup and handle. A cup and handle. Okay, so a cup and handle is a chart pattern that shows up in a bullish setting. So this could be on any time frame. People always ask me like, oh, like, is it on the 1 minute? Is it on the daily, the weekly? No, it can show up on any time period. And anytime you see these chart patterns, all it's doing is it's describing what is happening with price. So I used to think like, no way these patterns work, man. Like, people are just drawing stupid shit on the chart and trying to act like they know how to trade. I was like, no way this works. This really works because when you see these pictures, it's literally just describing what is happening. And every time that you see them, it just means that the same thing is happening in price. So it's kind of like if you're buying a pair of Jordans, price is just going to keep going up until, like, because the shoe is so rare, the price is going to keep getting bid up, right? But then if it's a less rare shoe, that price is not going to get bid up as high. So it's like a pattern. Oh, okay, I'm going to aim to sell a Jordan that's rarer so I can make more money. So it's a pattern. Like, okay, they're going to sell more rare Jordans because price is going to get run up more. So just like that's a pattern, these are patterns that show up on the chart that explain what's going on with price of a stock, okay, or an equity, commodity, whatever you're trading. So the cup and handle formation forms like this. We get a rounding bottom, and then we get pretty much a double top. That double top creates what's called a neckline. Okay, a neckline. We then get the handle part, which is pretty much just a retracement from that double top that comes down usually about 50% of the way of the depth of this cup. And then once we come back up and break this neckline, we usually get a measured move to the upside. What do I mean by a measured move up? I mean, it's a distance that you can actually measure to know how far it's going to go up. How do you measure that distance? Let me see if I made an example. I didn't do an example. Okay. The distance is basically going to be the depth of the cup. So from the low part of this cup, so the low point of this cup to the high, to the neckline, you measure that low to the high. You then take that measurement and start it from the bottom of the handle up. And that will be the height that we are expected to go up once we break above the neckline. Hopefully I have another example later. All right, so let's look at another pattern, ascending and descending triangles. So we talked about this in the first series as well, the descending triangle. So the descending triangle, we have a pretty defined support level, but then we keep getting lower highs. After each bounce, we get a lower high, bounce, lower high, bounce, lower high, until we actually fall out of that support. So we have a nice break below that support. It's a good sign of a continuation to the downside and a breakout to the downside. Now the same thing can be said about ascending triangles. So with ascending triangles, we have a clear resistance. We keep going up to that resistance, but in a lower low, boom, lower low, hit that resistance, lower low, until we essentially just break out. And in this case, QQQ absolutely flew the next day to a ridiculous level. It was ridiculous. There's better examples that I can show later. All right, and then we have our flag patterns. I don't really like these flag patterns because they don't really make sense. But anyways, flag patterns are basically when you have a move to the upside. This is a bull flag. You have a move to the upside, and then we consolidate for a little bit, and then continue in the direction of the original trend. In a bear flag, we move down, we trade in a parallel channel, and then eventually continue in the direction of that downtrend. Pennants are pretty similar, except instead of making a parallel channel, you get what looks to be like a wedge, and a wedge is just a triangle formation. All right. the head and shoulders pattern. So head and shoulders pattern, this one is an inverse because the head and shoulders pattern is usually face up. This is, or usually face down. This is face up. So, or it's usually face up. This is face down. Okay, you know what I mean. Anyways, we have this neckline here. Oh, computer's about to die. All right, so we have this neckline, and basically what's happening with an inverse head and shoulders is we put in a low, we go to this high, we put in a lower low. Okay, so if we go from a low to a lower low, then that's pretty bearish. That means that we're going lower. But then what happens is we get a flip, where we then go back to the highs, back to that high, and then put in a lower high, or a higher low. So we go from low to a lower low to a higher low. So that pretty much, this structure, this head and shoulders pattern, the inverse head and shoulders, is pretty much a good sign of a market structure shift. So from going from lower low, getting in this downtrend to now, hey, this is the start of an uptrend, and it's a really good start of an uptrend. So the way that you measure where we're going to go is you measure from the low of the head, the low of the head part, to the neckline. Once we break above that neckline, that distance from the low of the head to the neckline is the distance, the same distance that we should travel to the upside, that we're expected to travel once we break above that neckline. Okay, and then here are some of those chart patterns we talked about. You might want to just kind of take a screenshot here. This is really good stuff. Let's make this video long. Yeah, let's make it long. So the inverse head and the inverse hammer. Inverse hammer looks like this. It's at the bottom of a downtrend. We get this long topside wick at the bottom of the downtrend. The potential direction is now a reversal to the upside. The bullish engulfing bar. The bullish engulfing bar. At the bottom of a downtrend, we get a small red bar that is eaten up by a big green bar that shows you that the direction is probably going to go from going down to going up. Piercing line bar. I talk about this a lot. So if we have a big red bar, so a strong red body, or what we call a trend bar, a trend bear bar, it pushes down, right? So that shows a lot of selling pressure. Well, if we have a green bar that forms right after it, and that green bar goes above 50% of the length of this red bar, that means that we're probably going to reverse back up because we had enough buying pressure to take out a lot of this selling that just happened. So pay attention to these piercing line bars, especially when I mention them in a lot of the videos. Morningstar. So the Morningstar doji, again, remember we talked about dissipating selling pressure. So if your bars are getting smaller, that means that the pressure to sell is going away. There's less sellers. So at the bottom of a downtrend, that tiny doji right there, it's called the Morningstar doji. It shows you selling pressure is going away, and we're probably going to end up going back up. So these are really good signs of reversals. Right now I'm talking about bullish reversals. And then last but not least, the three white soldiers, basically three big bull bars in a row, showing you that we're going up. All right, now these are going to be signs that we're going down. So these are really good signs of reversals that we're going back to the downside. Number one is going to be the Hanging Man Doji. The Hanging Man Doji is insane. So at the top of an uptrend, you see it's pretty much a head, and then there's a long tail at the bottom showing that there's sellers here trying to push price down. Okay, trying to push price down. So this is at the top of uptrends. This next one is called a Shooting Star Doji. Again, it's showing you buying pressure is dissipating. We talked about how long topside wicks show you that sellers are stepping in. And just like the bullish engulfing, bearish engulfing is the bullish engulfing bar's brother. So at the top of an uptrend, we get this big red bar eating up the little green bar, and that usually is a sign of a reversal to the downside. All right, and then we have the Evening Star Doji. So again, it's a small bar. And then we have double top formations. We talked about that yesterday. We talked about double bottoms with neckline breaks in our video from yesterday. And then up down bars and down up bars. So micro double tops are signs of reversals as well. And what they show is it's a defined area where price does not want to go above. And then micro double bottoms are defined areas that price does not want to go below. They're also called up down bars or down up bars, but it's called the micro double top because it's a double top that's two bars that are right next to each other, and micro double bottom because it's two bars right next to each other. Okay, and then notice how we have a long top side wick and a micro double top. That's a guaranteed sign of an immediate reversal, and you can see how we had continuation to the downside here. And then we have these long bottom side wicks we just talked about. Shows price is getting pushed back up. Buyers are stepping in. So really good signs here. We could talk about key levels and stuff on another video again, but really good signs of like price action and just what price action looks like, what certain setups look like, what chart patterns look like. That will help you. A lot of these were really good for helping you find areas of reversals, areas where we'll get market structure shifts and where price is going to change in terms of direction, okay, where we get directionality changes in the markets. So hopefully this video helped somebody out there with your chart patterns. This is chart pattern number 2. We'll do a number 3 series that is going to be absolutely fire. You're like, oh wait, what else you got? Join the Discord and you'll see what else I got. Okay, but anyways, thanks for tuning in. It's Mr. Fit to Flourish. Your boy. Let's get this shmoney. I'm out.
It's not the game. You think you become a champion on the field? You don't. You become a champion when ain't nobody watching you. You're doing your own drills in your own way. You're doing what coach tell you to do, and you're doing your own stuff. You become a champion in the dark when ain't. It is the